Welcome. Good to have you with us. Why so dour on the markets, Greg?
So, Tyler, as you know, this has been my consistent view for some time now, even back to January when the market was focused on 7 rate cuts this year. And so now that the consensus is coming closer to my stated view at the beginning of the year that we'll have 0 rate cuts this year, I'm surprised that the market hasn't pulled back already more than it has. Remember that this rally, which kicked off in October, was driven by 2 things. It was driven by the euphoria that the battle with inflation was over and that we would be in a much lower interest rate environment in 2024, and the general AI euphoria as well. Well, only one of those remained, Tyler. And recent data suggests that we haven't seen disinflation in quite some time. In fact, what we saw is a spike in inflation over the first quarter. And what we saw is a spike in the things that lead to inflation over the first quarter, with wage growth going from 90 bips in the fourth quarter to 120 bips in the first quarter. And so overall, Tyler, we just don't have any evidence that we're seeing continued disinflation. 3.9% unemployment doesn't get us there. 30 to 40 basis points growth in core every month doesn't get us there. And wage growth that we're seeing right now, when still historical low jobless claims, simply doesn't get us there.
But you still have companies performing pretty well. You still have an economy that seems to be based partly on wage growth and unemployment and GDP growth. It seems to be doing pretty well. Can those 2 things overcome those negative factors that you just and correctly cite?
Tyler, those are actually part of the problem. I, like you and everyone else, root for great GDP growth, root for wage growth, root for earnings. But what a 6% earnings growth quarter shows us, and what 3 consecutive earnings growth quarters show us in a row, is that the Fed simply had not put in place an environment that was restrictive enough. The GDP environment shows us that even though we had a revision down, most of that downward revision was driven by a 4% contraction in durable goods. The services spending was up 4%. And as long as that remains the case, there's no attainable path towards 2% inflation. What the Fed has done simply is not restrictive enough. That is why I've maintained a likelihood, even to this day, that I think that the next move is actually a hike. That it's more likely we see a hike than a cut.
I think some people are coming around to that view, although the market's probably not quite there yet. It's sort of one of those things. Meanwhile, in the markets, whether you think there's a cut or a hike, you seem to agree with many others about some of these areas of opportunity, cloud and AI being one of them. You're also looking to Oracle as a name there. Cybersecurity, Greg, has been a huge area of strength. For the most part, a little bit more choppy. More headlines today, obviously, about big hacks. Are those stocks you'd stick with no matter what the Fed does?
Right, Kelly. And so, as you astutely point out, I am only poo-pooing one of the areas of euphoria that we've witnessed that drove the rally. The other, those that are tethered to secular and cyclical tailwinds, generational secular tailwinds like AI and cloud, as you rightly point out, I've always been an advocate for. I'm not ready to give up on cybersecurity yet. I think Palo Alto hasn't come nearly close to its highs that we saw back in February. And I think that the cybersecurity element of the AI ecosystem, of the cloud ecosystem, still isn't appreciated as much as it should be. And so I still think that there's relative outperformance in these names, particularly when we start to see a more restrictive environment take earnings growth for everything else down to low single digits. These names will still put up 20% plus earnings growth. So I think that's still an opportune area. Turning to the major beneficiaries of those secular tailwinds, AI and cloud, while the NVIDIAs and the Googles and the Microsofts, the obvious beneficiaries, have performed well, there's some laggards, like Oracle, for example, that has a unique and singular focus on the large enterprise, but is only up 12% in the last year. So I think we can start to spread our exposure, remaining focused on these themes, outward to some other names. But I still like cybersecurity as well.
All right, Greg, good to check in with you. Thanks for your time today. We appreciate it.